Did you know that just 0.1% of Bitcoin holders control over 27% of its total supply? This extreme concentration of wealth in crypto isn't just a statistic, it represents immense power that can, and often does, manipulate the entire market. A single whale, holding tens of thousands of Bitcoin, can initiate a cascade of fear or euphoria that wipes out millions from unsuspecting traders. By the end of this video, you'll know exactly how these crypto whales orchestrate market movements, from subtle price shifts to dramatic crashes and pumps. You'll understand their sophisticated tactics and, crucially, how to identify their footprints to protect your own investments. First, let's define who these whales are. In the traditional financial world, they are institutional investors, hedge funds, or ultra-high net worth individuals. In crypto, a whale is generally considered a wallet holding a significant amount of a particular cryptocurrency, often millions or even billions of dollars worth. For Bitcoin, this typically means addresses holding over 1,000 BTC, which currently sits around 16,000 unique wallets. These entities don't just own crypto, they are the market's liquidity, and their movements create ripples that can become tsunamis. Their sheer volume of holdings gives them disproportionate influence, allowing them to dictate trends rather than simply follow them. One of the most infamous whale tactics is the pump and dump scheme. This involves whales accumulating a large position in a low-cap altcoin, often one with low liquidity. Once they've quietly built their stack, they initiate a coordinated effort to drive up the price. This typically involves spreading exaggerated positive news, creating FOMO through social media groups, and buying in quick succession to create the illusion of high demand. As the price rockets, fueled by retail investors piling in, the whales begin to unload their holdings at inflated prices, leaving the latecomers holding bags of rapidly depreciating assets. For instance, in early 2021, various meme coins saw multi-thousand% pumps within days, only to crash by 80 to 90% shortly after, liquidating countless retail portfolios. It's like a game of financial hot potato, and you never want to be the last one holding. But here's where it gets interesting: whales don't always need to pump a coin to profit. They can also manipulate market perception through wash trading and spoofing. Wash trading involves a whale simultaneously buying and selling the same asset to themselves, creating artificial trading volume on an exchange. This makes a coin appear more liquid and popular than it actually is, attracting genuine traders. Imagine a ghost town suddenly appearing bustling with activity. That's wash trading. Spoofing, on the other hand, involves placing large buy or sell orders with no intention of executing them, only to cancel them just before they're filled. For example, a whale might place a massive sell order for 1,000 ETH at $2,000, creating perceived resistance and pushing the price down, only to cancel it and buy at a lower price. This tactic was so prevalent that the CFTC has issued several warnings and fines against individuals and entities engaging in it. It's a game of psychological warfare on the order book, designed to trick algorithms and human traders alike into making decisions based on false signals. Whales are also masters of initiating bear raids and exploiting short squeezes. A bear raid involves a coordinated effort to drive down the price of an asset, often by placing massive sell orders or shorting the asset heavily, then spreading negative news or FUD, fear, uncertainty, doubt, to amplify the downward pressure. Once the price plummets and retail investors panic sell, the whales buy back at significantly lower prices, closing their short positions for a substantial profit. Conversely, in a short squeeze, whales identify coins with a high number of short positions. They then initiate a rapid buying spree, pushing the price up. As the price rises, short sellers face increasing losses and are forced to buy back the asset to cover their positions, further accelerating the price surge. This creates a feedback loop that can liquidate millions in short positions, as seen in various crypto events where specific coins saw 50% price increases in mere hours, fueled by mass liquidations. Beyond direct buying and selling, whales strategically manipulate the order book itself. They place large buy walls or sell walls, massive limit orders at specific price points, to create artificial support or resistance. For example, a whale might place a 10,000 ETH buy wall at $1,800. This signals to other traders that $1,800 is a strong support level, encouraging them to buy or preventing them from selling below that point. However, these walls can be pulled at any moment, trapping retail traders who relied on them. They also exploit slippage, especially in low liquidity markets. By executing large market orders, they can consume multiple layers of the order book, causing their own trade to execute at increasingly worse prices, but also creating significant price volatility that they can then capitalize on through other positions. It's like a giant fishing net designed to catch smaller fish by creating chaos. Finally, whales leverage the power of news and social media to amplify their market moves. They don't just react to news, they often create it or strategically time their actions around it. This can involve leaking information, spreading rumors through influential channels, or even paying crypto influencers to shill or FUD a particular coin. Think of the impact of a single tweet from a prominent figure or a coordinated campaign across various Telegram and Discord groups. These digital whispers can trigger widespread FOMO or FUD, leading to massive inflows or outflows of capital, which whales can then use to offload their holdings at peak prices or accumulate at rock bottom. This information warfare weaponizes human psychology, turning sentiment into a tool for profit. The crypto market, despite its decentralized ethos, is not immune to the power dynamics of traditional finance. It's a battleground where the largest players, the whales, wield immense influence. They exploit market inefficiencies, human psychology, and technical vulnerabilities to their advantage. Understanding their strategies, from pump and dumps to wash trading, bear raids, order book manipulation, and information warfare, isn't just academic. It's your most powerful defense. Recognizing these patterns allows you to spot potential traps and avoid becoming collateral damage in their colossal trades. If you want to dive deeper into how to identify these market manipulation patterns in real time and develop robust risk management strategies, make sure to watch our next video on advanced charting techniques for spotting whale activity. Until then, remember, in the crypto ocean, awareness is your best shield against the leviathans.